Hey there and welcome to the channel. In today's video, we are going to be analyzing a company called Adobe, which I am personally invested in. We're going to start the video off by discussing how the company makes money. We are then going to go over their latest financial results and we'll go over my highlights from the earnings transcript. We will then talk a little bit about the management of the company and then talk about which super investors are invested in Adobe. We will then end the video by going over the key ratios that I track for all of my portfolio companies and we'll see if I'm still happy being a shareholder in Adobe. But before we get into it, like always, I do want to ask you to smash the like button and subscribe to the channel if you haven't already. And also leave me a comment below if you are invested in Adobe or if you have another company that I might be interested in making a video about. So after I had already edited the video and made it ready for YouTube, the news broke about Adobe ending its pursuit of Figma, where they are canceling the $20 billion acquisition, which in my opinion is great news, although Adobe has to pay Figma $1 billion. I do believe it's a much better deal for Adobe, and I think that Figma is worse off after the deal didn't go through. But let's see what CNBC had to say about it.
Adobe terminating its $20 billion deal to acquire the design software maker Figma. Let's get out west to Deirdre Bosa. That is the subject of today's Tech Check. Dee.
Hey, David, good morning. Let's talk about what it means for both parties going forward. Adobe, it's going to be just fine. Figma, though, perhaps its future a little less certain. When the deal was announced 15 months ago, there was sticker shock at the price. Adobe was willing to pay double Figma's valuation at the time and 50 times its annual recurring revenue. But while trying to get this deal done, Shantanu and the Adobe team, it hasn't slowed down. It's very much been a part of the Wall Street generative AI conversation with Firefly, and it has continued to develop Adobe Express, a real-time collaboration tool that does some of what Figma was supposed to do for the company. Plus, Adobe shares there are up over 60% since the deal was announced, and a major overhang regulatory uncertainty that is now removed. There's even hope, guys, that Adobe could use the cash that it earmarked for Figma for an expanded buyback.
So for those of you who are not familiar with Adobe, they basically make their money in three ways. They have their digital media, which is their biggest source of revenue, and that is divided into Creative Cloud and Document Cloud. And Document Cloud is, for example, Adobe Acrobat and all of the products related to that. But I do want to show you a 60-second clip about the Creative Cloud and all the products that Adobe has in their Creative Cloud for their clients. It always amazes me how much variety Adobe has to offer their clients that are subscribed to their Creative Cloud.
Adobe have dominated visual creative software for decades, but what do all the Creative Cloud programs do? Here's almost everything explained in 60 seconds. Photoshop is for retouching, manipulating and compositing photography and indeed any raster graphic, that's images made up of pixels. Many photographers spend more time in Lightroom, however, which helps you organise photos as well as edit them. Illustrator, by contrast, works with vectors, shapes produced by equations. Use it for creating logos, illustrations and packaging. InDesign is the go-to for multi-page layouts like books and magazines, and a great option for any print artwork. In Audition, you can record and edit audio. In Premiere Pro, edit professional level video. After Effects is for motion graphics and visual effects. Dimension is one of the easiest 3D programs to use, and there's also Substance for creating textures and materials. Dreamweaver is a web development tool that has waned in popularity but still has useful features if you like to switch between coding and visual previews. And finally, XD for creating wireframes, prototypes and user interfaces for websites and apps.
Now, digital experience is their smallest source of revenue, but it's really fast growing. It is basically a service where Adobe uses all of their platforms to help companies create content and grow online, where they have solutions like Adobe Analytics, Adobe Experience Platform, Adobe Campaign, Adobe Target, and Journey Optimizer. So you can see there is real value in getting Adobe to help you create content, especially if you have a high budget. So the results for 2023 were pretty much what you would expect as an investor in Adobe, where they had total revenue of 19 billion with a 10% year-over-year growth. And out of those 19 billion, the digital media segment generated 14 billion, which was 11% year-over-year growth. And the digital media segment did also add 1.9 billion of net new annual recurring revenue. But annual recurring revenue is something that Shantanu has been implementing in the company's business model. And that is, of course, one of the things that you want to have in a software company along with high margins. And the digital experience segment generated 4.8 billion, which was 11% year-over-year growth. And 4.3 billion out of those 4.8 billion was subscription revenue, which was a 12% year-over-year growth. Now, the company generated 7.3 billion of cash flow from operations, which is very similar to their free cash flow number since they don't have large amount of capital expenditures, and Adobe is continuing in repurchasing shares blindly like most Silicon Valley companies do. And those repurchases of shares along with stock-based compensation is something that I have always been unhappy with when it comes to the Silicon Valley giants like, for example, Meta and Adobe. We will go over that in more detail later in the video. And if we take a look at the result for their quarter, we can see that the remaining performance obligations, or RPO, exiting the quarter were 17.2 billion. So if you're wondering what RPO is, it is an indicator of the revenue that a company expects based on executed contracts that have not yet been fulfilled as of the end of a reporting period. So if you consider the fact that they generated 19 billion in revenue for the whole year, it is a good sign that they have an RPO of 17 billion. So if you take a look at some of the highlights from the Adobe Creative Cloud segment, there were 4.5 billion generations to date through the integrated Creative Cloud generative AI Firefly models. And it is safe to say that Adobe has been killing it when it comes to AI, which was something that a lot of investors feared when the AI craze started in early 2023, is that Adobe would get left behind. But they've showed us that they are a leader in the field. And they have their 3 new Adobe Firefly models, the Firefly Image 2, the Firefly Vector, and Firefly Design. Of course, this is not something that they've already turned into revenue, but they do have generative credits as a part of their Creative Cloud subscription plan, which is good if you think about it, that the company wants to keep their subscribers happy, and getting generative credits as a creator is really good so you can leverage AI to your advantage when you are creating content. And in the earnings call, the company talked about the record adoption of Photoshop Generative Fill and Generative Expand, which means that the company's customers are really happy with the new features. And if we take a look at the Adobe Document Cloud segment, we can see that Acrobat Web monthly active users was up over 70% year over year. And the management team is being successful in bringing in users into the Acrobat ecosystem, where their link sharing around PDF files increased 400% year over year. And the company is not just succeeding on desktop, where their Acrobat mobile monthly active users surpassed 100 million users in Q4. Next up, let's take a look at some of my highlights from the earnings transcript. And Shantanu, the CEO, mentions here that Q4 was their first ever $5 billion quarter, which is a new record for the company. And some positive news for the company, where Time Magazine recognized Adobe Liquid Mode, Photoshop Generative Fill, and Generative Expand among the best inventions of 2023. And Adobe was also recognized as a leader in over 25 industry analyst reports this year, including Gartner Magic Quadrant, which is very highly respected. And again, Glassdoor is listing Adobe as one of the best places to work. And if we go to Glassdoor.com, we can see the company has 9,400 reviews, where the company gets a rating of 4.3 stars out of 5, and 86% would recommend to a friend, and Shantanu gets a 94% approval rating as CEO. That is the highest approval rating that I've seen of all the companies that I've looked at on Glassdoor. And as an investor in the company, it's always good to see that the employees are really happy and the CEO seems to be doing a great job. Now, the next thing I want to touch on is the super investors invested in Adobe, or the lack of the super investors invested in Adobe. Now, as of this recording, there aren't any super investors that have a meaningful stake in the company, at least any super investors that I follow. And if we go to the sell section for Adobe, we can see in the last couple of quarters, 4 super investors that I highly respect have sold out of Adobe, with the last one being Chuck Acre of Acre Capital Management. Then you have Dev Kantasaria of Valley Forge. Then you have AKO Capital, and last but not least, Terry Smith for his fund, Fundsmith. But all of these investors have a similar investing style to me personally, where I try to find high quality compounders at a fair price and try to hold them for a very long time. And I do have to admit, it is quite concerning for me to see all of these investors exit. One thing I do want to mention before we get to the key ratios for Adobe is their stock-based compensation, which I mentioned earlier in the video and is in my opinion way too high. And if you compare, for example, the period from 2020 to 2023, we can see that the stock-based compensation has gone from 900 million up to 1.6 billion, and the cash from operations has only gone from 5.7 billion up to 8 billion. That is, in my opinion, way too much, but something that you probably have to get used to or at least accept if you are going to be investing in big Silicon Valley companies like Adobe. Now let's end the video by going over the key ratios that I track for all of my portfolio companies. And the most important metric that I track is the growth in free cash flow. And if we take a look at the 1-year free cash flow growth rate for Adobe, we can see that it's negative, which is obviously something that we don't want to see. But we have to zoom out a little bit and look at their 3-year and 5-year growth rates, which are 11% and 17%, which is pretty acceptable for a company that is as big as Adobe. Now, if you look at the valuation of the company, their enterprise value to free cash is really high at 37. Now, I personally bought into the company at around 20. And I would not be buying more stock at 37, but I won't be selling the stock either, so I'm fine to hold at this price. Because if you're trying to buy high quality compounders at a fair price, you have to be able to hold on to them when their evaluations go up. Now, if you take a look at the return metrics for Adobe, their return on invested capital is similar to their 5-year medium at 21, which is pretty good. Then you have their return on capital employed, which is 34 and is higher than the 5-year median of 29. And you also have their return on equity at 36%, which is higher than the 5-year median of 34%. Looking at the margins for Adobe, they have those juicy software gross margins of 87%, which have been pretty stable for the last 5 years. Their operating margin is high as well at 34% and is growing. The company has a high free cash flow margin of 35%, but is still lower than the median of 41%. Now, the company doesn't have much debt, where their debt to equity is 0.25. And they do have a good interest coverage ratio of 58. And also they have almost 2 times cash to debt, which is pretty healthy. Now, like we talked about earlier in the video, the company has been buying back their shares, but also diluting shareholders through stock-based compensation. But if you look at the 3-year share buyback ratio and the 5-year share buyback ratio, we can see that the numbers of shares outstanding is going down, which is something that we like to see. So in conclusion, as an investor in the company, I'm pretty happy to hold the shares. Adobe is a huge company that has a market cap of 266 billion, so we can't expect phenomenal growth rates in the coming years. But if you are able to buy into a company like Adobe at a free cash flow yield of around 5, where the company should be able to grow their free cash at about 8 to maybe 11 or 12% for the next couple of years, you should have a decent return on your money. Now, like I mentioned with the super investors, that is of course a concern for me, and I do look forward to watching the annual shareholders meeting for Fundsmith, where I hope that Terry Smith is able to answer some questions about him exiting Adobe. But I won't be making this video any longer today. I do want to ask you to smash the like and subscribe to the channel if you haven't already. I want to thank you for watching and hope to catch you on the next one.